Bank of Canada pauses their interest rate hike. Did anyone not expect this? Yeah, we're going to be talking about this article and this week's reaction video. And the second article that we'll be going over is 1/5 of CIBC mortgage borrowers seeing loan balances grow because of higher interest rates. That means people's mortgages are getting bigger. Is this going to affect you? Stay tuned to find out. Now, if you're looking for some help on how to navigate this real estate market, because things are, again, still all over the place, right? Every single segment is different. And you want to know the inside scoop of what's going on, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me. And then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name's Zhen, and I run and operate a RE/MAX in the Greater Toronto area on top of making awesome real estate educational videos just like this one for you. And the first article we will be talking about is Bank of Canada to hold interest rates at 4.5% through this year. I don't know if that headline's just kind of a bit clickbaity, but they're just saying it's conditionally paused right now. It could still very much go up. But I think a lot of people are expecting it to go up because of job reports. But I don't think anyone that actually follows macroeconomics of what's going on really expected them to increase this one, because they just said that they're going to pause in the last one, right? So what this means is basically we got potentially some more rate hikes coming depending on the economic condition. So in case you don't know, the next one is April 7, then I think it's June 12th. If I'm wrong, I'll put it up there, right? Now here's kind of the press release that Bank of Canada had, and I just want to highlight a couple things for you, right? So if you haven't been following, the GDP report for the last quarter in 2022, so Q4 came out and it was flat. They actually thought it was going to go up, but it was flat. So someone again in Stats Can or the Bank of Canada said can't do math. And then they also said that the labor market remains tight and employment growth has been surprisingly strong. So this is why everyone's been looking at the jobs report. So the jobs report will be coming out, I think, tomorrow. And if it goes on the increase, there could be kind of a little bit of wiggle room for them to increase the rates April 7th, because unfortunately, as much as it sounds, the Bank of Canada is trying to cause unemployment so that prevents the wage spiral, right? So what's basically going to happen is there could be some chances of the rates going up in April because of that, but there's obviously other factors such as CPI and other economical stuff that's happening. And at the end of the day, I don't even think these guys know what they're planning to do in April, right? Now, the other thing that they're kind of expecting is that they think that there's going to be pressures in the product and labor markets as expected to ease. I personally don't think so. I think we're in a decade of inflation, but we'll have to see. And then they're also saying that they're trying to get CPI down around 3% in the middle of the year. Now, I've said this before, we had peak inflation in 2022 in June. So when you do a year-over-year comparison, it really should be coming down relative to last year. And if it doesn't come down to 3%, we have a problem. It means that the inflation here that's sticking around is sticky. Now, they are expecting that short-term inflation to return to 2%. I don't think it's going to happen, and I think they're going to kind of change their expectations of what inflation is going to be in the future just because of reshoring, manufacturing, and the labor market right now is so tight. I can't really see the inflation going back to 2% unless they fudge around with some of the numbers, which we have known they've been doing in the past before. So that's kind of like my take on the Bank of Canada and the interest rate. Now, a lot of people are still looking at the Bank of Canada's interest rate hike as to see what the direction of the market's going, right? And I agree. The headlines will drive sentiment as they always have done, and because sentiment will change buyer behavior. But you have to understand, from the current technical side of how people are trading real estate right now, the Bank of Canada does not have much power right now. So you look at the chart over here, in the last little bit, 1/5 of all mortgages are variable, meaning that the other 80% is fixed mortgage. The Bank of Canada does not control the fixed rate mortgages anywhere between 1 to 5 years. They control the variable. So if only 20% of people are getting mortgages right now, the buyers who are buying right now, 80% of them are getting a fixed mortgage. I would argue actually more. So what that means is these buyers that are in the market right now and the multiple offers looking for these freehold properties, they are buying with a fixed rate mortgage. So I've had a lot of clients who are buying right now get pre-approvals because I told them to lock in the rate when the bond market was a little bit soft a month ago. So they have 90 days for that to go shopping right now. So those are the buyers that are in the market right now. When the rate hikes for Bank of Canada, if they do plan to have it, it's going to affect the people that are in the market right now that have a variable and didn't go to a fixed, because again, that also doesn't make sense. Separate video for a different time. But anyone who's feeling it on the variable side would be basically mortgage holders from Scotia or National Bank, because as the rates go up, their payments also go up. But it hasn't done so for all the other major banks, as I'll talk about later on this video. So basically what that means is if Bank of Canada does decide to increase any more interest rates, it's going to affect people who are holding on to properties right now at Scotia or National that may not be able to hold on any longer. So you may get some properties coming to sell if they're in that situation. But those are not distressed sellers. Again, the distressed sellers are probably coming in the B lenders in the private space. But at the moment right now, probably not so much. Now, if you found this content helpful, make sure you help me smash the like button and subscribe to the Prime Press channel so that you can spread the knowledge out there so people actually understand what the hell is going on in the real estate market, because there's a lot of weird stuff going on right now and it's not as kind of black and white as most people think. And if you do want to kind of get information advantage on how to navigate this real estate market, you can book a call with me. Yes, it'll be me talking to you using this link right here, www.chatwithzen.com. Okay, let's move to the second article. We got 1/5 of CIBC mortgage borrowers seeing loan balances grow because of higher interest rates. Dun, 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 dun. Are people going to sell? We talked about this before. Trigger rates, trigger points, yada, yada, yada. I'm going to give you a little bit of recap because a lot of people seem to be kind of spooked out by this, right? So they're saying here that because the banks reported their earnings, 20% of CIBC basically is seeing their loan balances grow. Now, when their loan grows with all of the major banks, except for Scotia, so that's CIBC, TD, RBC, BMO, you have that mortgage that's variable, but the payment is static, meaning it doesn't move. So now, because the interest rates are so high, it's not the current monthly payment that hasn't moved, isn't even actually covering just the interest payment alone, meaning that interest component is adding to the mortgage right now. Yeah, it's kind of crazy, right? So that's how a lot of people are negative amortizing, meaning they're, call it 25 to 30 year amortization is now stretching to 40 and 50. So if you didn't understand that, here's some math. Say you got a property, $100,000 mortgage. Let's just say your monthly mortgage payment, 2 years ago was $1,000, right? 500 for interest, 500 for principal payment. Now, because interest rates are so high, your actual interest payment is like, call it $1,200 a month, right? But you're only making $1,000 payment a month. So that extra $200 that you owe to the bank in interest is being tacked onto your mortgage. So now instead of that $100,000 mortgage, less whatever you paid for, you're now adding $200 a month to that $100,000 mortgage every single month. So that's what they're talking about. Now they're saying that's about $52 billion worth of mortgage, and that's a B, so that's a lot of mortgages. So here's the thing. A lot of people think, oh no, distressed sellers, but that's not really the case. Look at it this way. It is true that it's absolutely a sign of stress to come. It's just that the stress isn't here yet, because most of the people who have these mortgages at these big banks, they haven't really been called by their bank reps, or most of them that I know of, to increase the payment. Some of them have voluntarily do so to catch up on amortization, but if push comes to shove, these banks are going to force it on you. Now, there is an instance where TD is going to allow you to keep adding the interest to your outstanding mortgage up until 80% of the value of the home from when you purchased it. So appraisal value on hand, meaning that if you got a mortgage recently at TD, you have a limit of how much you've been adding on. From what I know, CIBC kind of, wishy-washy, hasn't said anything yet, because I have a CIBC mortgage as well. Now, on the RBC side, as long as you are making $2 of principal payment, generally you're okay. So you do have to slowly move up your interest, but not everyone has gotten that call yet. At least that's what I've been told when talking to my clients who have mortgages at different banks, right? Now, here's kind of the interesting thing that I'll point out. It says, at this time, we only see a small portion, less than 20 million of mortgages balances with clients are seeing as a higher risk from a credit perspective. Look, I think this is just foo-foo, because these guys need to kind of, boost up the stock price and dividend earnings, all that stuff. So they're saying that they're not at risk. These are all definitely at risk. The problem is, are the banking regulators going to force everybody to change it all right away and have a cascading effect where a lot of people are going to start defaulting and can't make these payments? I personally don't think so, and it's going to get bailed out, and that's what's going to be kicking the can down the road. So where risk does happen is a lot of these mortgages that are renewing, meaning that because they're basically increasing the amortization and the amount of debt that's owing, when they renew, they're not on track with the amortization schedule in which their contract dictates. So what that means is the banking regulators are going to have to change and let the banks either extend their amortization, or a lot of people, if they have the equity based on whatever the market value is at the time, they could refinance. So that's kind of the kicking it down the can some more. Is this mountain of debt and interest that's outstanding on the kind of balances of homeowners piling up? Absolutely. Are the banks going to try to basically get them all back? Probably not all at the same time, right? That's kind of what my thinking is right now. So that amortization is going to be a problem, and that's what I'm saying. Like at least a third of the mortgages right now at these big banks may need to be extended in, call it 2-3 years, when these 5-year variables or whatever the variable term is up. So that's what I'm saying. We're not going to see the stress right now. And again, it's still the B lenders and the privates that are at the end of their mortgage term. But these ones, we're probably going to see it in like a 2 to 3 years. So like 2021, 2022 plus 5. So that puts us as 2026 to 2027, right? We still got a long ways to go. The market can still go either way. If it does trade sideways for that long, we have problems. If it goes up, it's fixed. If it goes down, we have a bigger problem. That's essentially what's happening. Hopefully this kind of gives you an idea of what the hell is happening, all this interest rate stuff, this mortgage stuff, because a lot of crazy things are happening right now, on top of the fact that we are seeing kind of basically an acceleration in demand for the real estate market right now. So it is kind of all over the place. You just have to understand the macro, which is kind of the stuff I'm talking about right now, interest rates, which is kind of a short-term change. Then you got to look at the short-term stuff, which is the amount of inventory that's looking right now. And then sometimes also tie this in with kind of like the population growth and the demographic change of millennials and them having kids, all wanting 3-bedroom freehold homes right now. So when you mix all that stuff, you understand short-term, medium-term, long-term. Short-term being inventory, medium-term being the interest rates I just talked about in this video, long-term being the demographics and population growth. So that's why it's very kind of important to understand all these things when you're making a really big decision. And if you do want to work with someone who understands all this, like me, you can book a call with me using the link that's right here, www.chatwithzen.com. Until next time, your move, your future. See ya! Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.